Hi everyone, this is Prashad Parthiban. Today I'm going to take a training on underwriting process in property and casualty insurance. Basically, underwriting has three core functions. One is risk evaluation, the second one is risk pricing, the third one is policy servicing. During the risk evaluation, the underwriting team evaluates the applications received from the customers or the brokers and determine if we need to accept this risk or not. During the risk pricing, we determine the premium for the policy. So what kind of premium we have to charge based on the risk characteristics of the customers. During the policy servicing, we kind of do any endorsements based on the request from the customers or kind of cancellation reinstatement. Any servicing that the customer requests us, we do using the policy servicing step. Now, we know what is underwriting. Who does all those underwriting activities? They are called as underwriters. So the one who performs the underwriting functions. Now, there are a few underwriting evaluation characteristics. Like these are the characteristics that the underwriters looks at it and then determines, okay, we can accept this coverage. We cannot accept it. So they are type of business, what kind of business that we are kind of insuring, age of the business, financial characteristics, their size, sales and assets, or prior financial behavior like their credit score. Did they file any bankruptcies? The condition of the property, what kind of property they have and what is the condition. Any prior insurance claims, did the insured add any prior claims prior to getting a policy with us? Did the insured have any safety precautions within their property or any loss prevention practices? These are few of them. So underwriting team or the underwriters looks at these characteristics to determine if we need to accept the risk or to determine the premium, etc., etc. Now, with the latest advancements, instead of underwriting doing all those activities manually, some of these activities can be automated using technology. So that's what you're seeing it in the end section. The first thing is artificial intelligence. Like nowadays, what happens is all those complex kind of activities done by the underwriters can be programmed within the computer, and then the computer can do those instead of underwriting doing it. Like example, if there are prior losses, right, and then underwriter have to look at their prior loss history and then determine if we need to accept this particular customer or not. So the system can be programmed to look at those loss history, and then if the losses are less than 5 claims, then the system itself can issue the policy. If it's more than 5, then they can assign that to the underwriter. Instead of underwriter looking at every policy, some of the work can be offloaded and given by or done by the systems. Predictive analytics. So predictive analytics is where you look at the data of the past, history, and then determine how the future is going to look like. That's what we are predicting the future based on the historical data. Now, for one good example is, say, if I have a customer who has all these loss characteristics, like the type of business or the number of claims. So we kind of assign a score to each of these, characteristics. And at the end of the day, if the score is going to be higher, then we wanted the underwriter to look at the policy. If the score is less, then we wanted the system to automatically act on that policy or claim. Data mining, like we have the system who looks at the data of the customers, large data, right? When I say data mining, large data, and come up with some patterns. Okay, there are 100 customers who has this kind of loss characteristics. For this customers, let's give this kind of policy. So that kind of analysis can be done using data mining. Big data. Instead of having it in a relational database, nowadays big data can have any kind of data like structured data or pictures or any kind of unstructured data can also be stored in big data so that they can be evaluated to determine the actual premium. Smart products. We have seen this a lot nowadays. Like say if you have a personal auto policy, like you have a smart product installed in your car so that they evaluate your driving history and then based on that the premium can be calculated. Internet of Things, like nowadays there are systems that can talk to each other using the internet, and then based on the data that we collect we can determine the premium and other stuffs. I hope you like my training videos. If you like my training videos, please do subscribe to my YouTube channel. Have a great day. Bye bye.